Greetings, students. This video discusses transaction analysis. That's something accountants do in deciding the correct way to account for a transaction. I'm going to show you one method of doing this. It's based on the word decide. Each of the first 5 letters of the word help define transaction analysis. The first D stands for deciding whether or not a transaction is an economic transaction. An economic transaction is one that is measurable in monetary terms. So, hiring an employee is definitely a transaction, but it is not an economic transaction because it is not measurable in monetary terms. On the other hand, the pay the employee receives for their work is measurable in monetary terms, so it is an economic transaction. Once the accountant decides that a transaction is an economic transaction, the accountant needs to determine what accounts are affected. That's what the E in decide stands for. In our example, what accounts are affected when a company pays its employees? Remember, there are always at least 2 accounts that are affected. If you said cash and payroll expense, then you are correct. Step 3 is to classify each affected account in terms of whether it is an asset, a liability, or an equity account. In our example, the cash account is an asset account. The payroll expense account is part of equity, just like revenue accounts. We'll cover this a bit later in the course. Step 4 is to identify the amount of the effect. So if you pay the employee $1,000, then the amount of the effect is $1,000. The final step in transaction analysis is to make sure that the transaction that you booked balances. Total debits have to equal total credits. So that is the decide technique of transaction analysis. Now let's take a look at Luca Paciolo. We introduced Luca in our Introduction to Accounting in a prior video. Recall that Luca, in the 15th century, invented the system of accounting we use today. In that video, we said that Luca had a fruit stand. Let's assume that Luca sold 1 apple and received 1 florin, an Italian silver coin, in return. Luca, as you can see, is pondering how to record the transaction. Let's help Luca by applying the decide technique. Step 1. Is the sale of the apple for 1 florin an economic transaction? What do you think? Well, yes it is. Luca sold something of measurable monetary value in exchange for something else of measurable monetary value. Step 2. What accounts are affected? What do you think? If you think that cash and inventory are affected, you are correct. However, that is only half the story. There are 2 other accounts affected. Those accounts are sales and cost of goods sold. So, in total, there are 4 accounts affected. Step 3. Classify the accounts by type. Cash and inventory are asset accounts. Sales and cost of goods sold are accounts that will be closed out to equity at the end of the accounting cycle, so those are equity accounts. Step 4. Identify the amount of the effect. Well, in this case, the sale of the apple was for 1 florin, so we can debit cash and credit sales for 1 florin. Assuming that the apple cost Luca half of that, then the inventory value was 1/2 florin. So we can reduce inventory by that amount and increase cost of goods sold by that amount. So we credit inventory by 1/2 florin and we debit cost of goods sold by the same amount. Step 5, does everything balance? Well, yes, it does. So that's how we apply DECIDE to transaction analysis. Any questions?